Before we dive in, please remember that this video is for educational purposes only and is not financial advice. I am not a licensed insurance agent or financial advisor. Always consult with a qualified professional before making any decisions about your insurance coverage. You're probably overpaying for car insurance. In fact, there's a good chance you're throwing away hundreds, maybe even thousands of dollars every single year on a policy you don't even understand. You get that bill. You see the price. You sigh, you pay it, and you move on. But do you have any idea what you're actually paying for? For most of us, an auto insurance policy is a black box. A mandatory expense filled with a secret language of confusing terms like bodily injury liability, collision deductibles, and uninsured motorist coverage. Feels like it was designed to confuse you. And honestly, kind of is. Imagine this for a second: you get into a minor fender bender. Your fault. It's stressful, but you think, that's what I have insurance for. You call your provider, you file the claim, and that's when the real headache begins. They tell you that while your policy will cover the other person's car, the damage to your own car isn't covered because you cheaped out and skipped collision coverage to save $70 a year. Now you're facing a $4,000 repair bill out of your own pocket. Or even worse, imagine the other driver is seriously injured. You thought your $100,000 liability limit was a huge number, but their medical bills and lost wages total $300,000. Guess who they're coming after for the remaining $200,000? They're coming after you. Your savings, your house, your future. This isn't a scare tactic. This is the reality for millions of Americans who bought a product without understanding the fine print. They clicked a button for the cheapest rate without realizing that the cheapest policy is often the most expensive one when you actually need it. The insurance industry thrives on this confusion, but that ends today, right here, right now. In the next few minutes, I am going to pull back the curtain and demystify the 6 core parts of every standard American auto insurance policy. We're going to translate the jargon into simple, plain English. My goal is to arm you with the knowledge you need to walk into any negotiation with confidence, to read your own policy and know exactly what it means, and most importantly, to build the perfect coverage for your life without overpaying a single dime. We're going to turn you into the expert. So let's get started. Your entire policy is built around one central idea: protecting you from financial ruin. And it all starts with the one part of your insurance that is legally required in nearly every state. It's the absolute foundation of your coverage, and it has nothing to do with fixing your car. It has everything to do with fixing the damage you might cause to other people. This is liability insurance. It breaks down into 2 critical parts, and you need to understand both, because they represent 2 different shields protecting you from financial ruin. The first is bodily injury liability. The second is property damage liability. Let's start with bodily injury because it's where the numbers get terrifyingly big incredibly fast. Imagine you're driving home from work. You're tired. You glance down at your phone for just a single second to see a text. When you look up, the car in front of you has slammed on its brakes. You hit them. It's not a huge crash, but the other driver is complaining of neck pain. Their passenger is holding their wrist. An ambulance is called. This is where your bodily injury liability kicks in. It does not pay for your medical bills. It pays for their medical bills. It pays for their ambulance ride, their emergency room visit, their x-rays, their physical therapy, their chiropractor appointments for the next 6 months. But it doesn't stop there. What if the driver is a surgeon and can't work for 3 weeks because of the injury you caused? Your bodily injury liability pays for their lost wages. What if they sue you for pain and suffering because of the chronic headaches they now have? Your insurance company will hire lawyers to defend you, and if you lose, your bodily injury liability pays that settlement up to your policy limit. This is where we have to talk about the numbers. On your insurance policy, you'll see a set of numbers that look something like this: 25/50th, or maybe 50/100, or 100/300. These aren't just random numbers. They represent thousands of dollars and are the absolute core of your financial protection. The first number is the maximum amount your insurance will pay for any single person's injuries in an accident you cause. Let's say you have the state minimum, which in many places is $25,000. That's the 25 in 25/50th. So, in our scenario, the driver of the car you hit has medical bills and lost wages that total $35,000. Your insurance will write a check for $25,000. That's it. That's their limit. The other $10,000? That's on you. The other driver's lawyer isn't just going to forget about it. They will come after you personally for that $10,000. They can go after your savings account. They can put a lien on your property. They can garnish your future wages, taking a piece of your paycheck every single week until it's paid off. A single moment of distraction just put you $10,000 in debt. Now let's look at the second number, the 50 in 25/50ths. This is the maximum total amount your insurance will pay for all injuries combined in a single accident you cause, no matter how many people are hurt. So back to our crash. The driver has $35,000 in bills. Remember, your policy only covers $25,000 of that. Now what about their passenger? The passenger's broken wrist and therapy costs add up to $20,000. Since $20,000 is less than your per-person limit of $25,000, your insurance covers it all. The total payout for both people is $25,000 for the driver plus $20,000 for the passenger, which equals $45,000. Since $45,000 is less than your $50,000 per accident limit, you're good on the total amount. But you are still personally on the hook for that extra $10,000 for the driver because you blew past the per-person limit. Now, I want you to stop and think about the reality of those numbers. $25,000. Does that sound like a lot of money? An ambulance ride can be over $1,000. A single night in a hospital can be $5,000 or more, before any doctors or treatments. A simple surgery can easily cost $30,000, $40,000 or more. Your state minimum $25,000 limit can be completely wiped out by a single broken bone. And we're only talking about one person. What if you cause a multi-car pileup and injure 4, 5 or 6 people? That $50,000 per accident limit will evaporate in an instant, leaving you exposed to hundreds of thousands of dollars in medical bills and lawsuits. This is the number one way people are driven into bankruptcy after a car accident. They were trying to save $5 or $10 a month on their insurance premium by carrying the lowest possible limits, and in doing so, they put their entire net worth on the line. Okay, let's move to the second part of liability, property damage. This one is simpler. It pays to repair or replace anything you hit and damage with your car that isn't a person. Most of the time, this means the other person's car. But it also covers a mailbox you run over, a fence you crash through, or even the front of a building you accidentally drive into. Just like with bodily injury, there's a limit. On your policy, it's the third number. So if you see 25/50/25, that last 25 means your insurance will pay a maximum of $25,000 for all property damage you cause in a single accident. Now let's ask the same question we did before. Is that enough? 10 years ago, maybe. Today? Absolutely not. Think about the cars on the road right now. The average price of a new car is approaching $50,000. You make a mistake and total a brand new Honda CR-V. You're already in the hole. But what if you don't hit a CR-V? What if you rear-end a brand new Ford F-150, the most popular vehicle in America? That can easily be a $60,000 truck. What if you clip a Tesla Model S? You're looking at an $80,000 car. A BMW, a Mercedes, a Lexus? You could easily be looking at a bill for $70,000, $80,000, even $100,000. Your state minimum $25,000 property damage limit is a joke in that situation. Your insurance pays the first $25,000, and you are personally sued for the remaining $55,000. And it's not just about totaling a car. Modern vehicles are packed with incredibly expensive technology. A simple fender bender isn't simple anymore. That bumper you dented now contains sensors for blind spot monitoring, cameras for the backup system, and radar for adaptive cruise control. Replacing and recalibrating that bumper alone can cost $5,000. A new LED headlight assembly on a luxury truck can be over $2,000 for a single light. A minor accident that looks like just a few scratches can quickly turn into a $15,000 repair bill. If you cause a chain reaction and damage 3 cars, your $25,000 limit is gone before you even finish talking to the police officer. So let's put this all together. Liability insurance is not for you. It's for everyone else on the road. It is the financial shield that stands between a simple mistake and a life-altering lawsuit that could destroy everything you've worked for. Choosing your liability limits is arguably the single most important decision you will make when you buy car insurance. Opting for higher limits like 100/300/100 might cost you a few extra dollars each month, but it is the cheapest asset protection plan you will ever find. It's buying you hundreds of thousands of dollars of protection for the price of a few cups of coffee. So liability insurance covers damage you do to other people and their property. It's the law, and it protects your assets from lawsuits. But that leaves a massive glaring question. If you cause the accident and liability only pays for them, who pays to fix your car? Who pays for your medical bills? The answer is a completely different part of your policy, the part that actually protects your own vehicle. This is the part that most people think of when they buy full coverage insurance. It's broken into two main pieces, collision and comprehensive, and they are not the same thing. Let's start with collision. The name says it all. This coverage pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, a fire hydrant, or even the wall of your own garage. It also covers damage from rolling your car over. Collision is the coverage that kicks in when you are at fault in an accident. Remember our scenario where you rear-ended that brand new luxury car? Your liability coverage paid for their repairs. Your collision coverage is what you'll use to pay for your repairs. Without it, you'd be writing a check to the body shop for thousands, maybe even tens of thousands of dollars, completely out of your own pocket. Or you'd be staring at a crumpled heap of metal in your driveway with no way to fix it. But here's the critical detail you absolutely must understand. Collision coverage comes with a deductible. A deductible is the amount of money you have to pay out of pocket for a claim before your insurance company starts paying. Think of it as your share of the repair cost. Deductibles typically range from $250 to $2,000, with the most common being $500 or $1,000. Let's make this simple. Imagine your car has $8,000 worth of damage from that accident. You have a $500 collision deductible. You file a claim. You pay the first $500 directly to the repair shop. Your insurance company then pays the remaining $7,500. If you had a $1,000 deductible, you'd pay the first $1,000, and insurance would cover the remaining $7,000. So which deductible should you choose? A low one or a high one? Well, this is one of the most direct ways you can control the price of your insurance. It's a simple trade-off. A lower deductible, like $250, means you pay less out of pocket if you have an accident. But because the insurance company is taking on more risk, they're going to charge you a higher premium. Your monthly or semi-annual bill will be bigger. Conversely, a higher deductible, like $1,000 or $2,000, means you are agreeing to take on more of the financial risk yourself. You're telling the insurance company, "Don't worry about the small stuff. I can handle the first $1,000 of damage." In return for you taking on that risk, the insurance company gives you a lower premium. Your bill will be cheaper. The right choice depends entirely on your financial situation. The golden rule is to never choose a deductible that you couldn't afford to pay, in cash, on a moment's notice. If coming up with $1,000 tomorrow would be a serious financial crisis for you, then a $1,000 deductible is probably too high. It might save you $15 a month on your premium, but that savings will feel pretty meaningless when you can't afford to get your car out of the shop. You need to find the sweet spot between a premium you can afford and a deductible you can comfortably pay. Okay, so that's collision. Covers you when you hit something. But what if something happens to your car that has nothing to do with you driving it? What if a massive hailstorm turns your car's roof into a golf ball? What if a tree branch snaps in a windstorm and crushes your windshield? What if you walk outside in the morning and your car is just gone, stolen from your driveway? Or what if, and this happens over 1 million times a year in the US, you hit a deer? In all of those cases, your collision coverage would do absolutely nothing. You would be completely on your own. This is where the second piece of the puzzle comes in. Comprehensive coverage. Sometimes it's called other than collision coverage, which is a clunky but very accurate name. Comprehensive protects you against damage to your car from events that are, well, other than a collision. Think of it as the weird stuff or act of God coverage. It covers fire, theft, vandalism, falling objects, explosions, earthquakes, windstorms, hail, water, and flood damage. It's also what covers you if you hit an animal like a deer, which is a common point of confusion. Hitting a deer is not considered a collision with an object in the same way as hitting a telephone pole. It falls under comprehensive. Just like collision, comprehensive coverage has its own deductible, and it works the exact same way. If a thief smashes your window and steals your stereo, causing $1,500 in damage, and you have a $250 comprehensive deductible, you pay the $250, and the insurance company covers the remaining $1,250. You can even have different deductibles for each coverage. It's very common for people to have a $500 collision deductible, but a lower $100 or $250 comprehensive deductible, since comprehensive claims like a cracked windshield are often less severe and more common. So now the big question, do you actually need collision and comprehensive? Unlike liability insurance, no state legally requires you to have them. So technically, you can drive without them. But, and this is a huge but, if you have a loan on your car or you are leasing it, the answer is almost certainly yes. Your lender or leasing company, the bank that technically owns the car until you pay it off, is going to require you to carry both collision and comprehensive coverage. Why? Because the car is their asset. It's their collateral for the loan they gave you. If you wreck the car and don't have the insurance to fix it, they're stuck with a worthless piece of metal and a loan that you might just stop paying. They require you to have full coverage to protect their investment. If you drop these coverages while you still have a loan, the bank can, and often will, buy a very expensive policy on your behalf and tack the cost onto your loan payment. It's called force-placed insurance, and it's something you want to avoid at all costs. But what if you own your car outright? No loan, no lease. The title is in your name, free and clear. Should you still pay for collision and comprehensive? The answer comes down to a simple personal calculation. Could you afford to replace your car tomorrow if it were totaled? If your car is worth $25,000 and you don't have $25,000 sitting around to buy a new one, then you absolutely need these coverages. The monthly cost is a small price to pay for the peace of mind of knowing you won't be financially devastated by a single accident. However, if you're driving an older car that's only worth, say, $2,000, and you have a $1,000 deductible, the math starts to change. In a worst-case scenario, the most your insurance company would ever pay out is $1,000, the value of the car minus your deductible. You have to ask yourself, is it worth paying hundreds of dollars a year in premiums for a maximum potential payout of just $1,000? For many people with older, low-value cars, the answer is no. They choose to self-insure, meaning they drop collision and comprehensive, save that money on their premiums, and accept the risk that if they wreck their car, they'll have to pay to replace it themselves. So now we've covered the other driver and we've covered your own car. The property is all taken care of. But in any accident, there's a far more valuable and fragile element involved than bumpers and windshields. There are people. Specifically, there's you and there are your passengers. What happens if you get hurt? Who pays for the ambulance, the emergency room, the x-rays, the physical therapy? Your health insurance might cover some of it, but not all of it. And what if you don't have health insurance? This is where your auto policy steps in once again, with a completely different set of coverages designed to protect not your property, but your person. This first line of defense is called medical payments coverage, or MedPay. Think of it as a dedicated, no questions asked health fund specifically for car accidents. It doesn't care who was at fault. If you are injured in a car-related incident, it pays. You, your family members, any passenger in your car at the time of the crash, they're all covered. That immediate ambulance bill? MedPay can cover it. The emergency room copay? MedPay. The x-rays, the stitches, the follow-up visit with a specialist? MedPay is there for it, up to the limit you choose. And its reach is surprisingly long. Let's say you're not even in your car. You're out for a jog, crossing the street in a crosswalk, and a car clips you. Your MedPay coverage can kick in to cover your injuries. Same thing if you're riding your bicycle. It's an incredibly flexible safety net. The limits are typically on the lower side, maybe $1, $2, $5, or $10,000. It's not designed to cover a catastrophic, life-altering injury. It's designed to handle the immediate, often surprisingly expensive, costs of getting checked out and patched up, without you having to dip into your savings or worry about your health insurance deductible. If you have a high-deductible health plan, MedPay is your best friend, because it can pay that deductible for you, unlocking your main health coverage without a massive out-of-pocket hit. But in about a dozen states, there's an even more powerful version of this coverage. It's like MedPay's bigger, stronger, more capable sibling. It's called Personal Injury Protection, or PIP. If you live in a no-fault state like Florida, Michigan, or New York, you are required to have this. And what is a no-fault state? It's simply a system designed to get injured people paid faster. Instead of waiting months or years for lawyers to fight over who was at fault, the no-fault system says that your own insurance company pays for your injuries first, regardless of who caused the accident. This gets money flowing for medical care immediately, and PIP is the engine that makes this system work. So what makes it so much more powerful than MedPay? One simple, game-changing fact. PIP doesn't just cover medical bills. It covers so much more. Let's go back to our accident. The crash left you with a severely broken leg that requires surgery and a long recovery. Your medical bills are piling up, but the real crisis is something else. You can't work. You're a plumber, a teacher, a freelance graphic designer. Your income depends on you being able to function. You're going to be out of commission for 8 weeks. Who's going to pay your mortgage? Who's going to buy groceries? This is where PIP becomes a financial lifesaver. It can cover a significant portion of your lost wages while you recover. That is a benefit MedPay simply does not offer. But it gets even better. PIP can also cover what are called replacement services. While you're laid up on the couch, life doesn't stop. The lawn needs mowing, the house needs cleaning, your kids still need to be cared for. PIP can provide money to hire someone to do these essential tasks that you're now physically unable to perform. It's designed to keep your entire life from falling apart, not just to pay the doctors. And in the most tragic circumstances, PIP also provides a death benefit and can cover funeral expenses. So, MedPay is the first aid kit for your wallet, covering the immediate medical sting. PIP is the full-on paramedic, stabilizing not just your health, but your entire financial life. Now, this brings us to a terrifying question. What happens if the person who slammed into you has no insurance at all? Or, almost as bad, they have the absolute bare minimum coverage required by law? You're a responsible driver. You have good insurance. You did everything right. But the other driver, the one who was texting and blew through a red light, is what the industry calls a ghost. They have no policy. They might not even have a valid license. Their liability coverage, which was supposed to pay for your wrecked car and your mountain of medical bills, is zero. A big fat nothing. Or maybe they have a policy, but the property damage limit is $5,000. Your brand new SUV is worth $50,000. Their bodily injury liability is capped at $25,000, but you just had spinal surgery and the bill is already over $100,000. You're now facing a devastating financial black hole, created entirely by someone else's irresponsibility. Are you just out of luck? Are you supposed to sue this person, who likely has no assets to their name, and spend years in court trying to get blood from a stone? No. This is precisely why the next two coverages are, in my opinion, the most important and tragically underrated parts of any auto policy. They are uninsured and underinsured motorist coverage. Let's call them UM and UIM. These are the coverages that protect you from the ghosts. Let's start with uninsured motorist, or UM. When the at-fault driver has no insurance, your own insurance company does something remarkable. It puts on a mask and essentially pretends to be the other driver's insurance company. Your UM coverage steps in and pays for the things their liability policy should have paid for. First and foremost, it covers your bodily injuries. Your surgery, your hospital stay, your physical therapy, your pain and suffering, all of it can be covered by your own UM policy, up to the limits you selected. In some states, there's also a separate uninsured motorist property damage coverage, which will pay to repair or replace your car. It's your shield against the completely uninsured. Then there's its partner, underinsured motorist, or UIM. This one is for the second scenario where the other driver had insurance but just not enough. Their policy pays out its maximum. Let's say it's that $25,000 limit. The check is sent to the hospital, but it's just a drop in the bucket against your $100,000 bill. You still have a $75,000 gap. This is where your UIM coverage kicks in. It covers the difference between what their policy paid and what your actual damages are, again, all the way up to your own policy's UIM limit. If you have a UIM limit of $100,000, it can cover that remaining $75,000 with ease. Please listen to this carefully. Do not skip these coverages to save a few dollars a month. According to the Insurance Research Council, 1 in every 8 drivers on the road in the United States is uninsured. That's more than 12%. In some states like Mississippi and Florida, it's over 20%. That means in any crowded intersection, there's a very real chance one of the cars around you is a ghost. A financial time bomb waiting to go off. UM and UIM coverage isn't just car insurance. It's a form of financial survival insurance. It's you insuring yourself against the worst decisions of a total stranger. So now we've protected your car from physical damage, we've protected your assets from lawsuits, and we've protected your body and your bank account from the consequences of an injury, even if the other driver is a ghost. Seems like we've covered all the bases, but the ordeal isn't over. Your car is still a twisted heap of metal sitting in a tow yard. You're cleared to go back to work next week, but you have no way to get there. How do you deal with the immediate logistical chaos of a car crash? The standard coverages we've discussed won't pay for a tow truck, and they certainly won't give you a car to drive while yours is being repaired. For that, you have to tap into a different part of your policy, the optional coverages that are all about convenience and keeping your life moving. Let's talk about that moment. The moment after the crash, after the police have left, after the tow truck has hauled away the twisted metal that used to be your car. You're standing on the side of the road, or maybe you're back home, and the adrenaline starts to fade. It's replaced by a cold, sinking feeling, a question that echoes in your mind. How am I going to get to work tomorrow? How are you going to pick up the kids? Get groceries? Your life, your entire routine was built around that vehicle. And now it's gone, sitting in an impound lot or a body shop, and it could be weeks before you see it again. This is where the real stress of an accident begins. It's not just about the repair bill. It's about the complete and total disruption to your life. And this is precisely where your basic liability, collision, and comprehensive coverages draw the line. They are there to fix the metal. They are not there to fix your life. For that, we need to talk about the unsung heroes of your auto policy, the optional coverages that are built for reality. The first, and arguably the most important, is rental reimbursement, sometimes called transportation expense coverage. Think of it as a lifeline. While your car is in the shop for a covered repair, this part of your policy steps in and pays for you to have a rental car. But, and this is critical, it's not a blank check. Your policy will have specific limits, and you need to know them. It's usually written as two numbers, something like 30/900 or 50/1500. What does that mean? A 30/900 limit means the insurance company will pay up to $30 per day for a rental, with a maximum total payout of $900 for the entire claim. So if you rent a basic sedan for $28 a day, you're covered. But if you decide you want to rent a luxury SUV for $70 a day, you're on the hook for that extra $40 every single day. The $900 limit is your total cap. $30 a day, that gives you 30 days of a rental. For most repairs, that's plenty of time. But if there's a parts delay or a major issue, you could hit that cap. That's why it's so important to look at your own policy. Do you have a big family? Maybe you need a higher daily limit to afford a minivan. Do you live in an area where rental cars are expensive? You need to adjust for that. For a few extra dollars a month, you can often upgrade from a $30 a day limit to a $50 or even $75 limit. And when you're standing there without a car, that small difference feels monumental. It's the difference between cramming your family into a tiny compact or having the space you actually need to live your life. Now let's shift gears. Not every car problem is a catastrophic accident. Sometimes it's far more common and in some ways more frustrating. Picture this. It's 10 p.m. on a Sunday. You're driving home on a dark, empty stretch of highway, and suddenly you hear that dreaded thump, thump, thump. A flat tire. Or maybe it's a frigid January morning, and you turn the key in the ignition only to hear that sickening silent click of a dead battery. You're stranded. What do? You could call a local tow truck, and if you can even find one, be prepared to pay $100, $150, maybe even $200 out of pocket right then and there. Or you could have roadside assistance coverage. This is another one of those optional coverages that costs next to nothing on your policy. We're talking maybe $10 or $20 for the entire year, but delivers incredible value when you need it most. It's your 24/7 on-call mechanic. With one phone call to the number on your insurance card, they'll dispatch help for all the common roadside nightmares. They'll send someone to change your flat tire. They'll give you a jump start. If you locked your keys in the car, they'll send a locksmith. Run out of gas? They'll bring you a few gallons. And if the problem is more serious and your car can't be driven, they will tow it to the nearest qualified repair shop, all covered under your policy up to a certain mileage limit. It transforms a moment of pure panic into a manageable inconvenience. Instead of frantically searching Google for a tow company and worrying about getting ripped off, you make one call to a trusted source. It's peace of mind, bottled and sold for the price of a few cups of coffee a year. But let's go back to the big accidents, to the worst-case scenarios, because there are two more optional coverages that can literally save you from financial ruin. The first one is called gap insurance. And if you have a loan or a lease on your car, you need to listen to this very, very carefully. We all know that cars depreciate. The second you drive a new car off the lot, it loses thousands of dollars in value. Here's the problem. Your car's value depreciates much faster than your loan balance goes down, especially in the first few years. This creates a dangerous financial gap. Let's use an example. Say you buy a car for $30,000. You put a little money down and finance $28,000. A year later, you get into a major accident, and your car is declared a total loss. The insurance company looks at the market, at similar makes and models, and determines your car's actual cash value, what it was worth the second before the crash. is only $22,000. They write you a check for $22,000. But here's the gut punch. You check your loan statement, and you still owe the bank $26,000. The insurance company paid you $22 grand. You still owe $26. That means you have to take that $22,000, give it all to the bank, and then reach into your own pocket and write a check for an additional $4,000. $4,000 out of your savings, for a car that is now a heap of scrap metal. You are paying for a ghost. That is the gap. And that is what gap insurance is for. If you had it, after the insurance company paid its $22,000, your gap coverage would have stepped in and paid the remaining $4,000 difference to the bank. It wipes the slate clean. You walk away owing nothing. No debt, no financial disaster. You can just focus on getting a new car. If you are leasing a car, it's almost always required. If you are financing, especially if you put little or no money down or have a long loan term of 60, 72, or 84 months, you are almost certainly upside down on your loan, and you absolutely need to consider gap insurance. It's a shield against the brutal reality of depreciation. Finally, for those who buy brand new cars, there's one more layer of protection: new car replacement coverage. It's similar to gap, but even better. Let's go back to our example. You buy a brand new $30,000 car. A few months later, it's totaled. Your comprehensive or collision coverage pays you the actual cash value, which might be, say, $25,000 because of depreciation. You've lost $5,000 of value instantly. But with new car replacement coverage, the insurance company doesn't just give you the depreciated value. They give you enough money to buy a brand new car of the same make and model, same trim level from the current model year. They essentially ignore depreciation. If your 3-month-old car is totaled, you get a 0-mile car to replace it. It's the ultimate do-over. Typically, this coverage is only available for the first year or two of a car's life, but it ensures that a stroke of bad luck doesn't turn your dream car into an instant $5,000 loss. These coverages, rental reimbursement, roadside assistance, gap, and new car replacement, aren't legally required. You can drive without them. But they are the coverages that separate a standard policy from a great one. They are the ones that protect not just your vehicle, but your wallet, your time, and your sanity. They are the safety net for the real world. But now that we've covered how to protect your own car and your own convenience, we have to talk about a terrifying risk that comes from everyone else. What happens when the person who hits you doesn't have insurance? Or doesn't have enough? Because the hard truth is, millions of drivers on the road right now are breaking the law. And if they hit you, you could be the one left paying the price. This is the single biggest gamble you take every time you get behind the wheel. Because it's not about how good of a driver you are. It's about the person in the other car. The person texting, the person who had one too many drinks, the person who decided paying for insurance was optional this month. When they crash into you, their problem instantly becomes your nightmare. Their lack of responsibility transfers directly to your bank account. Medical bills, lost wages from being unable to work, the cost of physical therapy. It all lands squarely on your shoulders. You could sue them, sure. But what are you going to get? You can't get blood from a stone, and you can't get money from someone who doesn't have it. So you're left with a wrecked car, a broken body, and a mountain of debt. All because someone else broke the law. This is not a rare, 1 in a million scenario. Depending on your state, as many as 1 in every 4 drivers on the road with you has no insurance. Think about that. On your next commute, count 4 cars. Statistically, one of them is a financial time bomb waiting to go off. This is precisely why your insurance policy has a section that has nothing to do with your mistakes, and everything to do with protecting you from theirs. It's your personal financial bodyguard. And it's called uninsured and underinsured motorist coverage. Let's call it UM and UIM for short. This is the part of your policy that says, I'm not going to let someone else's irresponsibility ruin my life. Let's start with uninsured motorist coverage. It's beautifully simple. If a driver with 0 insurance injures you, your UM coverage steps in and acts like the insurance they were supposed to have. It pays for your medical expenses, your passengers' medical expenses, and even lost wages if you can't work because of your injuries. Imagine you're waiting at a red light. Suddenly, you're violently rear-ended by a driver who was looking at their phone. They get out, they're apologetic, but when it comes time to exchange information, they admit they don't have insurance. Your neck is in searing pain, you need an MRI, you missed 2 weeks of work. The bills start piling up. $20,000 in medical bills and lost income. Without UM coverage, that $20,000 is your problem. Your health insurance might cover some of it, but you'll still have deductibles, copays, and they won't give you a dime for the wages you lost. But if you have uninsured motorist coverage, you file a claim with your own insurance company. They pay your $20,000. They become the good guy, stepping in to clean up the bad guy's mess. And here's a critical detail most people don't know. Uninsured motorist coverage also protects you in a hit and run. If someone sideswipes you on the freeway and speeds off, or smashes into your parked car overnight and disappears, as far as your insurance company is concerned, you were hit by a ghost. A ghost with no insurance. Your coverage can be triggered to pay for your bodily injuries in that exact scenario. Without it, you're completely on your own. Some states require you to carry Many don't. But making it optional is like making a seatbelt optional. You're only betting against yourself. Now let's talk about its equally important twin. Underinsured motorist coverage. This one is more subtle, but it's just as dangerous. This covers you when the at-fault driver does have insurance, but they only have the bare minimum required by law. And let me tell you, state minimums are terrifyingly low. In some states, a driver is perfectly legal with just $25,000 of bodily injury liability coverage. $25,000. What does that cover in today's world? One ambulance ride in a few hours in the emergency room? It's a joke. Let's play out a more serious scenario. You're driving through an intersection on a green light, and someone runs the red, T-boning you on the driver's side. It's a bad one. You're hospitalized for a week, you need surgery on your leg, and you'll be in physical therapy for months. The total cost for your medical care balloons to $150,000. The driver who hit you is clearly at fault. The police report says so, and they have insurance. You feel a moment of relief. But then you find out they only have the state minimum liability of $25,000. Their insurance company cuts you a check for $25,000, their maximum limit. And that's it. They wash their hands of the situation. They fulfilled their legal obligation. So now what? You're still holding a bill for $125,000. $125,000 that you are personally on the hook for. This is where fortunes are lost. This is how people lose their homes, their savings, their retirement. All because someone else chose the cheapest possible insurance plan. But if you have underinsured motorist coverage, this story has a different ending. Let's say you were smart, and you chose limits of $250,000. Your insurance company sees that the other driver paid their $25,000. They then step in and pay the remaining $125,000 of your medical bills. Your coverage filled the gap, the massive life-altering gap left by the other driver's inadequate policy. You are made whole. Your savings are safe. Your future is secure. This is not an upsell. This is not a luxury. This is a fundamental piece of financial armor. People often say, "Well, I have good health insurance, so I don't need it." That's a dangerous misconception. Your health insurance does nothing for your lost income. It does nothing for your passengers who might not have health insurance. And most importantly, in many cases, if your health insurance pays for an accident-related injury, they have a right to be reimbursed from any settlement you get. This is called subrogation. So if you get that $25,000 from the other driver's insurance, your health insurance company might just take it right back, leaving you with nothing. and UIM are specifically designed for this situation. So how much should you get? The advice is simple and powerful. Match your uninsured and underinsured motorist limits to your own bodily injury liability limits. The logic is flawless. If you decide that you need $100,000 of liability coverage to protect your assets in case you hurt someone else, doesn't it make sense that you would need at least that much to protect yourself if someone else hurts you? You're essentially buying a policy for yourself that's as good as the one you're required to buy for strangers. Don't value yourself any less than you value a random person on the street. Get the same limits. And when you're talking to your agent, ask about stacking. In some states, if you have 2 cars on your policy, stacking allows you to add the UM/UIM coverage from both cars together. So 2 cars with $100,000 of coverage could potentially give you a $200,000 safety net for the price of a small fee. It's a pro tip that can literally double your protection. The bottom line is this: liability coverage protects your assets from a lawsuit if you cause an accident. But uninsured and underinsured motorist coverage protects your health, your family, and your financial future from the 1 in 8 drivers who are a rolling disaster waiting to happen. It is the single best bargain in the entire world of insurance. We've now covered how to protect yourself from financial ruin, whether the accident is your fault or someone else's. But we've only been talking about the human cost, the medical bills and lawsuits. We haven't talked about the single most expensive piece of property most of us own besides our home, the car itself. What happens to your car? If the other driver is at fault and has good insurance, their property damage liability pays for your repairs. But what if they're one of those uninsured drivers we just talked about? What if a tree falls on your car during a storm? What if it gets stolen from your driveway? Or what if the accident is your fault? The coverages we've discussed so far won't pay you a single penny to fix or replace your own car in any of those situations. For that, you need two other distinct types of coverage, and getting them wrong is the most common way people end up with a policy that fails them when they need it most. These two coverages are called collision and comprehensive, and together, with liability, they form the trifecta that most people call full coverage. But here's the first secret the industry doesn't really want you to know. Full coverage isn't a real insurance product. You can't buy it. It's just a nickname, a shorthand for a policy that has three key ingredients: liability, collision, and comprehensive. We've covered liability. Now let's break down the two that protect your wallet from your own car repairs. First up is collision coverage. The name is pretty straightforward, but its application is broader than you might think. Collision pays to repair or replace your car if it's damaged in a collision with another object, or if it overturns. The key word here is collision. This is the coverage that kicks in when you are at fault in an accident. You rear-end someone at a stoplight? Your liability pays for their car, but it's your collision coverage that pays to fix your crumpled front end. But it also covers you when you hit something that isn't another car. Imagine you're driving on a slick, rainy night. You take a turn a little too fast, lose control, and slam into a guardrail. That's a collision. Your collision coverage will pay for the repairs. You're trying to back out of a tight spot in a parking garage, and you scrape your door all along a concrete pillar. That's a collision. You swerve to avoid a squirrel and end up hitting a mailbox and a fire hydrant. That's a collision. Even if you're in a single-car accident where you flip your vehicle on an icy road, that's considered a collision. In all of these scenarios, without collision coverage, you are 100% on your own. You'd be paying out of pocket for every single dent, scratch, and broken part. Now, there's a critical component to collision coverage you have to understand: the deductible. A deductible is the amount of money you have to pay out of pocket before your insurance company starts paying. Think of it as your share of the repair cost. Deductibles for collision typically range from $250 to $2,500, with $500 and $1,000 being the most common. Let's make this real. Say you have a $1,000 deductible on your collision coverage. You get into that at-fault accident and the body shop quotes you $6,000 to repair your car. You will pay the first $1,000 directly to the repair shop. Your insurance company will then pay the remaining $5,000. If the damage was only $800, you'd pay the full amount yourself because it's less than your deductible. Your insurance wouldn't pay anything. This is where people get into trouble. To get a lower monthly premium, they'll choose a super high deductible, say $2,000. But when an accident happens, they don't have $2,000 sitting around to pay their share. So their car sits broken because they can't afford the deductible to even start the repairs. The golden rule is to choose a deductible you could comfortably pay tomorrow, in cash, without derailing your finances. So, collision covers you when you hit things. But what about all the other bad stuff that can happen to your car when it's not even moving? What if a massive tree branch snaps off in a windstorm and crushes your roof? What if a hailstorm makes your car look like a golf ball? What if you walk out of the mall to find your car is just gone? Stolen? This is where the second piece of the full coverage puzzle comes in: comprehensive coverage. Comprehensive is best understood as non-collision coverage. It's for almost everything else: the bizarre, the unexpected, the acts of God. It covers damage to your car from things like theft, vandalism, fire, flooding, hail, windstorms, and falling objects like that tree branch. It also covers one very specific type of collision: hitting an animal. This is a weird but incredibly important distinction. If you swerve to miss a deer and hit a tree, that's a collision claim. But if you hit the deer directly, that's a comprehensive claim. Why? The logic is that you can't really be at fault for a deer suddenly deciding to leap in front of your car. It's considered a random, unavoidable event, which is what comprehensive is for. And this matters because comprehensive claims are generally seen as less risky by insurers and are less likely to raise your rates than an at-fault collision claim. Just like collision, comprehensive coverage has a deductible. It works the exact same way. If a thief breaks your window and steals your stereo, causing $1,200 in damage, and you have a $250 comprehensive deductible, you'll pay the $250, and your insurance will cover the remaining $950. Often, people choose a lower deductible for comprehensive than for collision, because the premium for it is usually much cheaper. The odds of a total loss hailstorm are just lower than a fender bender. So let's put it all together. You're driving to work. Someone cuts you off, you swerve, and you hit a pole. Your collision coverage pays to fix your car after you pay your deductible. The next week, a massive hailstorm rolls through your town. Your comprehensive coverage pays to fix all the dents after you pay that deductible. A month later, you come out of your apartment to find your car stolen. Your comprehensive coverage will pay you the actual cash value of your car after your deductible. You can see now why just having liability is a massive gamble. It leaves your own asset, your car, completely exposed. And if you have a loan or a lease on your car, the lender will almost certainly require you to carry both collision and comprehensive. They have a financial interest in that vehicle, and they want to make sure it's protected until you've paid it off. If you own your car outright, especially if it's an older car with a low market value, you might decide to drop these coverages to save money. If your car is only worth $1,500 and your deductible is $1,000, it might not make financial sense to pay a premium for a potential $500 payout. But for most people with cars of any significant value, going without them is like walking a tightrope with no safety net. We've now covered the protection for the other guy's car and property, and we've covered the protection for your own car. Liability, collision, comprehensive, the big three. But we've overlooked the most valuable thing involved in any car accident. It's not the steel, the glass, or the rubber. It's the people inside. What happens when you or your passengers get injured? Who pays for the ambulance, the emergency room, the x-rays, the physical therapy? Your health insurance? Maybe. But what if you have a high deductible? What if your passengers don't have health insurance at all? This is where your auto policy can step in with a whole different set of coverages designed not to protect cars, but to protect people. And understanding them can literally be the difference between a full recovery and financial ruin. Let's start with the scariest scenario imaginable. You're driving perfectly, following all the rules, when suddenly, out of nowhere, another car slams into you. It's a bad one. Your car is wrecked and you're seriously hurt. The other driver? They speed off. A hit and run. Or maybe they stop, but when the police arrive, you get the gut-wrenching news. They have zero insurance. Absolutely nothing. So who pays? Who covers your hospital bills, the months of physical therapy, the wages you'll lose from being unable to work? Who fixes your car? Your health insurance might cover some medical costs, but what about the rest? What about the pain and suffering? This is where the single most important coverage you can buy comes into play. Uninsured motorist protection. Think of it this way. Uninsured motorist, or UM, coverage forces your own insurance company to step into the shoes of the at-fault driver who had no insurance. It essentially pretends to be the insurance that other drivers should have had, and it pays you for your losses. This coverage is typically broken down into two critical parts. First, and most importantly, is uninsured motorist bodily injury, or UMBI. This is your financial life raft. If you are injured by an uninsured driver, or a hit-and-run driver, UMBI is what pays for your medical expenses. Not just the initial ambulance ride and emergency room visit, but the surgeries, the follow-up appointments, the rehabilitation, the chiropractic care. It also covers lost wages. If you're a contractor who can't work for 6 months because of a shattered leg, this coverage replaces that lost income. And critically, it also provides compensation for pain and suffering, the non-economic damages that can be the largest part of a serious injury claim. Without UMBI, you could be physically and financially broken by someone else's catastrophic irresponsibility, left to sue an individual who has no assets to collect from. With UMBI, you have a direct path to recovery through your own policy. The second part is uninsured motorist property damage, or UMPD. This one is more straightforward. It pays to repair or replace your car if it's damaged by an identified uninsured driver. You might be thinking, wait, doesn't my collision coverage do that? And you're right, it does. So why have UMPD? The primary reason is the deductible. UMPD often has a much lower deductible than collision coverage, sometimes as low as $100 or $250, compared to a common $500 or $1,000 collision deductible. Using your UMPD saves you money out of pocket. In some states, however, you can't carry both collision and UMPD, as they see it as redundant. In that case, your collision coverage would handle the repairs after a hit and run or an accident with an uninsured driver, but you would be responsible for your full deductible. Now let's tweak the scenario. The driver who hit you didn't flee, and they do have insurance. You breathe a sigh of relief, until you find out they only carry the bare minimum liability coverage required by their state. Let's say their state minimum for bodily injury is only $25,000 per person, but your injuries are severe. Your medical bills alone are $80,000, and you've lost $20,000 in wages. That's a $100,000 loss. The at-fault driver's insurance company will write you a check for their policy limit of $25,000, and that's it. They've fulfilled their legal obligation. So where does the other $75,000 come from? This is the gap that underinsured motorist coverage, or UIM, is designed to fill. It's the silent hero of your auto policy. Underinsured motorist coverage kicks in when the at-fault driver has insurance, but not enough insurance to cover your damages. In our example, after you receive the $25,000 from the other driver's policy, you can then file a claim with your own insurance company under your UIM coverage. Your policy would then pay the remaining $75,000, up to the limits you selected for your UIM coverage. This is why it is absolutely critical to have and UIM limits that are high enough to protect your own assets and earning potential. Choosing state minimums here is like bringing a water pistol to a house fire. You are betting your entire financial future on the hope that if someone hits you, they are a responsible person with excellent insurance coverage. Looking at the number of uninsured and underinsured drivers on the road, that is a terrible bet to make. and UIM are not about protecting your car. They are about protecting your health, your family, and your financial security from the actions of others. But what if you're in an accident and it's not immediately clear who is at fault? Or what if you are the one at fault? Or what if you're a passenger in a friend's car when they get into an accident? This is where another layer of personal protection comes in, and it works regardless of who caused the crash. These coverages are called medical payments and personal injury protection. Let's start with medical payments coverage, often called MedPay. This is an optional, no-fault coverage available in many states. It pays for reasonable and necessary medical and funeral expenses for you and your passengers if you're injured in an accident, no matter who is to blame. It's designed to provide immediate funds for things like health insurance deductibles, co-pays, ambulance fees, or dental work. The limits are usually lower, typically ranging from $1,000 to $10,000. The beauty of MedPay is its speed and simplicity. There's no waiting for a lengthy fault investigation. If you're hurt in a car crash, you can access these funds right away to start paying bills. It also follows you, meaning it can cover you if you're injured as a pedestrian or cyclist hit by a car. Now, if you live in what's called a no-fault state, you'll have something similar but far more comprehensive called personal injury protection, or PIP. Think of PIP as MedPay on steroids. Like MedPay, it covers your medical bills regardless of fault, but it goes much further. PIP can also cover a percentage of your lost wages, often up to 80%. It can also pay for essential services, which is a huge benefit. For example, if your injuries prevent you from taking care of your children or doing household chores, PIP can help pay for childcare or a cleaning service. It's designed to keep your life running as smoothly as possible while you recover. In no-fault states, PIP is mandatory, and the idea is to reduce lawsuits for minor injuries by having each driver's own insurance handle their initial medical costs. So let's put it all together. You have liability to protect you when you're at fault. You have collision and comprehensive to protect your car from physical damage. And now you have this powerful suite of coverages to protect the most valuable thing of all: you and your passengers. Uninsured and underinsured motorist coverage protects you from the financial devastation caused by irresponsible drivers. And MedPay or PIP provides an immediate financial cushion for medical bills and other losses, regardless of who caused the accident. These aren't just add-ons. They are the core of a policy that truly protects your well-being. Raising your limits on these coverages often costs just a few extra dollars per month, yet it can increase your protection by tens or even hundreds of thousands of dollars. It is, without a doubt, the best investment you can make in your auto insurance policy. Now that we've built this fortress of protection, what about the other things? The conveniences? And more importantly, how do insurance companies take all of this information and boil it down into that one number you dread seeing every 6 months, your premium? Let's start with those little extras, the creature comforts of your insurance policy. Think of them as the optional upgrades on a new car. You don't need heated seats, but on a cold morning, you're really glad you have them. First up is rental reimbursement. This one is simple. If your car is in the shop for a covered repair after an accident, this coverage pays for a rental car. Without it, you're stuck bumming rides or paying out of pocket for a rental, which can add up to hundreds or even thousands of dollars. It's a small price to pay for not having your life grind to a halt just because your car is out of commission. Then there's roadside assistance. This is your knight in shining armor. It's for when you get a flat tire in the middle of nowhere, when you lock your keys in the car, or when your battery dies in the airport parking lot. Instead of frantically searching for a local tow truck company and hoping they don't rip you off, you make one call. It's the ultimate peace of mind coverage, the safety net that catches you during those small, infuriating car emergencies. These are great, but they're the side dishes. Let's get to the main course. The big scary question: how do they come up with that number? Your premium. Why does your neighbor with the same car pay $100 less a month? Why did your rate go up when you didn't even have an accident? Feels random, feels personal, but it's not. It's a cold, calculated science. The science of risk. Every insurance company is, at its core, a massive data-driven fortune teller. Their entire business model is based on predicting the future. Specifically, predicting the likelihood that you will cost them money. Your premium is simply the price they charge for taking on your specific level of risk. They determine this risk by building a detailed profile of you, your car, and your environment. They are detectives, and every piece of information is a clue. Let's break down exactly what they're looking at. First, and most importantly, they look at you, the driver. Your age is a huge factor. This isn't ageism, it's statistics. Drivers under 25, especially teenagers, are statistically far more likely to get into accidents. They have less experience behind the wheel, and their brain's risk assessment centers aren't fully developed. So, a 19-year-old male is, in the eyes of an insurer, a much higher risk than a 45-year-old mother. Next is your driving record. This is the most direct clue of all. Do you have speeding tickets? At-fault accidents? A DUI? Your past behavior is the best predictor of your future behavior. A clean record tells them you're a safe, responsible driver. A record full of violations screams, liability waiting to happen. Every ticket is a red flag that pushes your premium higher. Here's a controversial one: your credit-based insurance score. Now hold on. This is not the same as your regular credit score, and it has nothing to do with how much money you have. What decades of data have shown insurance companies is a strange but powerful correlation. People who are responsible with their finances also tend to be responsible behind the wheel. They're more likely to maintain their car, follow the rules, and avoid risky situations. It's not a perfect measure, and it's banned in a few states, but in most places, a better insurance score can significantly lower your premium. They even look at things like your marital status. Again, it's all about statistics. The data shows that married individuals tend to file fewer claims than single individuals. They are seen as more stable and less risky. It's not a judgment, it's just what the numbers say. The second major category of clues is your CAR. The make and model are critical. Insuring a brand new Porsche 911 is going to cost a universe more than insuring a 10-year-old Toyota Camry. Why? Several reasons. The Porsche costs a fortune to repair. Its parts are expensive and it requires specialized labor. It's also a high-performance sports car, which signals to the insurer that its driver might have a taste for speed. And finally, it's a massive theft target. The Camry, on the other hand, is cheap to fix, parts are everywhere, and while it's a reliable car, it's not exactly a magnet for car thieves. The age of your vehicle also plays a role, but it's a double-edged sword. A newer car might have advanced safety features that can get you discounts, like automatic emergency braking and blind spot monitoring. But those same features involve complex sensors and cameras that are incredibly expensive to replace if they get damaged, even in a minor fender bender. An older car might be cheaper to repair, but it may lack basic safety features like side impact airbags, making injuries more likely in a crash. And that leads directly to safety ratings. Insurance companies love cars that protect their occupants. They pore over crash test data from the Insurance Institute for Highway Safety. A car with a top safety pick award is a car that's less likely to result in expensive medical claims, and that means a lower premium for you. The final category of clues is your world, the environment where you live and drive. Your zip code is one of the most powerful factors in your auto insurance rate. If you live in a dense, urban area with high rates of accidents, vandalism, and theft, your premium will be higher. It doesn't matter if you're the safest driver on earth. The simple fact that you park your car in a high-risk environment means the chance of something bad happening to it goes way up. If you live in a quiet, rural area with very little traffic and crime, your risk is lower and so is your premium. They also look at weather patterns. Areas prone to hail, flooding, or other severe weather will see higher comprehensive coverage rates. They also want to know how you use your car. Are you a commuter, driving 20 miles each way in rush hour traffic 5 days a week? Or do you just use your car for pleasure, driving a few miles to the grocery store on weekends? The more you're on the road, and the more you're in heavy traffic, the higher your statistical probability of getting into an accident. Your annual mileage is a direct input into their risk equation. More miles equals more exposure to risk. So, imagine the insurance company taking all of these data points, dozens and dozens of them, your age, your driving record, your insurance score, the make, model, and safety rating of your car, your zip code, your daily commute. They feed all of it into a monstrously complex computer algorithm. This algorithm is their crystal ball. It sifts through mountains of historical data from millions of other drivers and compares you to people with similar profiles. It calculates the precise statistical probability of you filing a claim and how much that claim is likely to cost. Out of that black box comes a single number: your premium. It's not personal. They don't know you. They just know your data. You are a risk profile, and your premium is the price tag they put on that profile. Now that might sound grim, like you're just a number in a machine powerless to change your fate. But that's not the whole story. Understanding how they build the price is the first step to deconstructing it. Because within every one of these factors is an opportunity. An opportunity to prove the algorithm wrong, to lower your risk profile, and to take back control of that number. You have more power here than you think. So let's start with the most powerful levers you can pull, the things you can do this week, maybe even today, to see a real difference. We'll call this the quick strike. First, and this is the undisputed champion of saving money on car insurance, you have to shop around. I know you've heard it before, but you haven't heard it like this. You see, we tend to think of insurance companies as these monolithic, unchanging entities. The rate they gave you is the rate. That is the lie. The truth is, these companies are in a constant, desperate war with each other for your business. Their pricing algorithms are changing constantly, sometimes weekly. They're testing new models, targeting new demographics, and adjusting to their own financial performance. The company that gave you the best rate last year might be actively trying to shed customers with your exact profile this year. Loyalty is a myth the industry sells you. In reality, it's often punished. The loyal customer is the one they can slowly raise rates on, year after year, betting you won't notice or won't go through the hassle of leaving. Your single greatest weapon is to make them compete. Get at least 3, preferably 5 quotes. Don't just use one online tool. Use several, and then call a local independent agent who can shop even more carriers for you. This one action, which takes about an hour of your time, is the financial equivalent of finding a winning lottery ticket. It is the single highest paying hourly gig you will ever have. Second in our quick strike arsenal, the bundle. Insurers love customers who are sticky. A customer with just car insurance can leave at any time. But a customer with auto, home, and maybe even an umbrella policy? That's a customer who is tangled up in their ecosystem. It's a hassle to move all those policies. And for that stickiness, they will give you a massive discount, often between 10 and 25%. If you have renter's insurance or homeowner's insurance with a different company, you are very likely leaving free money on the table. Make the call. Combine your forces. Third, become a discount detective. Your insurance company has a long list of discounts, and they are not going to volunteer them. You have to ask. And I mean specifically. Don't just say, "Do I have all my discounts?" They'll say yes. You have to interrogate them. Do you offer a discount for having an advanced degree? What about for being a member of a specific alumni association or credit union? I work from home now, my annual mileage has dropped by 8,000 miles. I need the low mileage discount applied. Think about your life. Are you a good student? Is your kid on the honor roll? Did you install a new anti-theft system? Did you switch to paperless billing? Will they give you a discount for paying your entire 6-month premium upfront instead of monthly? Each one might only be a few percentage points, but they stack. This is a game of inches, and you win by finding every single one. And the final quick strike tactic, a policy review. When you first got your policy, you might have had a brand new car with a big loan on it. So you got the works. High liability limits, low deductibles, collision, comprehensive, the whole 9 yards. But what about now? Is that car now 10 years old and paid off? That full coverage, especially collision and comprehensive, might cost you $800 a year on a car that's only worth $2,000. You have to do the math. At a certain point, you become self-insured for the value of your car. Maybe it's time to drop that coverage. Maybe it's time to raise your deductible from $250 to $1,000. That one change can save you hundreds of dollars. Your life isn't static, and your insurance policy shouldn't be either. Now that's the immediate battle. But to truly win the war, you have to play the long game. These are the strategies that change your fundamental risk profile. First and foremost, your driving record. This is the foundation of your entire insurance score. Every single day that you drive without a ticket or an accident, you are actively investing in your future self. You are lowering your premium. Think of it that way. Safe driving isn't just about avoiding a crash. It's a financial strategy. And if you do have a minor ticket or accident on your record, don't just surrender to it. See if you can take a defensive driving course. In many states, completing one of these courses can remove points from your license or, at the very least, qualify you for a significant discount for several years. It's a way to actively repair your record. Next, and this is the one that surprises most people, your credit score. You might think, what does my credit card have to do with my driving? To an insurer, it has everything to do with it. Statistical models analyzing millions of people over decades have shown a strong correlation between how people manage their finances and how they manage their risk behind the wheel. A person who pays their bills on time is seen as more responsible, more forward-thinking, and therefore, less likely to get into an accident. It's not about being rich. It's about being reliable. Improving your credit score is one of the most powerful long-term levers you can pull, not just for insurance, but for your entire financial life. Pay your bills on time every single time. Keep your credit card balances low. Don't open a bunch of new accounts at once. As your score ticks up, your insurance premium will tick down. And finally, the longest game of all, your choice of vehicle. The next time you are shopping for a car, insurance costs should be as important a factor as gas mileage or trunk space. Before you fall in love with a car on the lot, get an insurance quote for it. You might be shocked. It's not just about a red sports car costing more than a gray sedan. It's about the data. How much does this specific model cost to repair? How often is it stolen? What are its safety ratings? A car with advanced safety features like automatic emergency braking and blind spot monitoring doesn't just protect you in a crash. It can get you a serious discount. A car that's cheap and easy to repair will have a lower collision premium. A car that isn't a target for thieves will have a lower comprehensive premium. You can find this data online from places like the Insurance Institute for Highway Safety. A 5-minute search before you buy can save you $5,000 in insurance costs over the life of the car. So what's the takeaway from all this? It's that your insurance premium is not a fixed price. It's not a tax. It is a dynamic, negotiable number that you have a tremendous amount of influence over. It's a system, and now you understand the rules. Here's my challenge to you. Set a calendar reminder. Once a year. Call it Insurance Freedom Day. On that day, you run the playbook. You check your credit report. You review your policy for outdated coverage. You call your current insurer and ask for every single discount you can think of. And then, you take 1 hour and you get 3 new quotes from their competitors. You make them fight for your money. You take back control. Because understanding this system isn't just about saving a few $100s. It's about a fundamental shift in mindset. It's about realizing that these complex financial products that seem so intimidating are just puzzles. And once you see how the pieces fit together, you can start arranging them to your advantage. You are no longer just a customer. You are the player. This is your game to win.